Welcome to the third and final module in the Investing for Women and Getting Started education program. In Module 1, we made the case for why you should invest, whereas in Module 2, we looked at some of the things you need to know and understand before you start investing. This module will quickly recap some of the knowledge from Module 2 and add on a couple of other things that you should know and understand, and then we will discuss how you actually get started. Now I'm going to cover this quickly just as a refresher. If any of these aren't completely clear, please go back to Module 2 and refresh your knowledge on these items. In the previous module, we discussed knowing yourself, meaning, are you naturally a spender or saver? Do you have time set aside to learn and focus on your financial affairs? And do you completely understand your behavior towards investing and risk? Another part of getting to know yourself is knowing what you are investing for. Meaning, what are your goals? Is it retirement? Is it a vacation or property purchase? Or perhaps you are saving for your child's education. Setting clear goals is key to getting started. We did also cover risk versus reward. Remember, if your investment value rises and you sell that investment and earn a profit, that is your reward. But if your investment value decreases, you sell and incur a loss, that is your risk. Risk refers to the probability that you may lose money on an investment you made. Rupee cost averaging is an investment strategy that we discussed. Utilize this strategy to bring your average cost of investing down. Also helps to automate your saving and investments by automatically investing in regular intervals. Asset allocation is the percentage of stocks, bonds, and cash in your portfolio, whereas diversification is the spread of money within each of the asset classes. The asset classes referred to here are stocks, bonds, and cash. Lastly, we also reviewed the investment choices you have, which were cash and cash equivalents. Then we had bonds or fixed income. We also discussed stocks or equities. Finally, we discussed mutual funds and ETFs that are pooled funds managed by a professional money manager. Now that you have a better understanding of why, what, where, and how to invest, it is time to get started. Depending on your comfort level and your investing preferences, you may choose to manage your own investment plan, or you may prefer to work with a licensed professional. There are two key considerations that should drive your decision: the cost of investing and the support and service provided. In either case, it's important that you take your time and evaluate your options, and we will discuss this further shortly. If you plan to start investing in the stock market, it's very important to possess a good understanding of stocks and shares. Regular investments along with a check of financial risk can help you save a significant amount of money over time and reach your financial goals. Always keep these tips in mind as you are starting out. Set your goals and objectives in advance to know where you are headed. Continue educating yourself throughout the process. Analyze the level of risk so that you are mentally and financially prepared. Control your emotions when it comes to investing. Make sure you are diversified. Get professional support to help you along the way. Over time, the impact of fees on your investment returns can be significant, and it's important that you understand what fees you will incur when making investment decisions. This is because they can potentially reduce the return, meaning the profit of the investment that can affect the performance of individual holdings. The fees you may have to pay falls into the following categories. First is the cost to buy or sell an investment. When buying or selling a stock or ETF, you may have to pay a trading fee. In case of mutual fund, you may have to pay an upfront fee, which is usually a specified percentage of the amount you invest, or you may have to pay a fee when you redeem the fund. Second is the investment management fee. These relate to mutual funds and ETFs that charge a management expense referred to as the management expense ratio or MER within the fund to pay for the professional management of the fund's holdings. The fee is calculated as percentage of the value of the holdings and is taken directly out of the fund, which reduces the overall return you receive. This fee varies based on the type of fund. The third is financial advisors' fees. Depending upon the financial institution a financial advisor works with, there are several ways an advisor can be paid. Advisors may charge a commission for the purchase or sale of an investment and or charge a percentage fee based on the value of the investment they advise you on. In some cases, an advisor may charge you a fixed price for services they provide, such as creating a financial plan. Lastly, there are administration fees for accounts. Firms that administer the accounts on your behalf will typically charge an annual fee to cover things such as reporting for taxes, statements. Here's a disclaimer that one should make. Please check with your financial planner for the latest fees and rules. These may seem like a lot of fees, but a well-planned investment strategically will also look to minimize these expenses, and this is where a financial professional's value really shines, as the value outweighs the fees. There are 4 main categories of taxable events that can be triggered by your investments. Please check with your financial planner or Indian tax resources for the latest in tax rules. The first is interest. Interest paid on an investment such as a bond is 100% taxable as income at your tax rate. The second is dividends. When dividends are paid to you from an investment in a company, they are grossed up for the purpose of calculating tax, and a corresponding tax credit is issued, lowering the income tax you must pay. The third is capital gains and losses. This is where we talked about earning a profit or a loss. When you sell an investment, you may have either a capital gain, that is when you receive more than you paid for it, or a capital loss, which is when you receive less than you paid for it. A percentage of this gain or loss is included in your taxable income. Lastly, foreign property. If you receive interest, dividends, or capital gains from investments outside of the country, you must report this income in your tax return. It is very important that you report all sources of income on your annual tax return. There are many qualified tax specialists who can help you with this. Understanding the way your investment income will be taxed can guide you in deciding which type of account to hold your investments. So the big question, how do you go about investing? Here are 3 ways. The first is do it yourself, or better known as self-directed investing. If you choose to make your investment choices on your own, there are many websites, articles, blogs, and social media sources you can consult. Be sure to research multiple sources so that you know you are getting accurate information. You open a brokerage account, transfer money into that account, and you begin making trades, meaning buying and selling investments. Something that has evolved from self-directed is online investment providers, better known as robo-advisors. This is a newer option available to you to invest directly with an online investment advisor or robo-advisor. These firms provide professional money management services over the internet, usually for a lower fee. Depending on the amount you have to invest and your investment goals, they will recommend a portfolio of holding designed to help meet your needs. In most cases, you will not speak with a professional advisor, as the service relies heavily on the computer-generated recommendations. Lastly, the more traditional option is using a professional. Whether that is a broker, a financial advisor, fund distributor, these professionals who have been trained and licensed to invest for you. Working with a qualified financial advisor can be very beneficial to a new investor. Depending on their training and registration, they can advise you on a range of investment options that may be suitable for you. There are many different types of advisors, so you will want to understand the different products they can sell, the services they provide, and the fee they charge. Just to expand on hiring a professional, there's definitely an upside to hiring a professional. Investment professionals offer a variety of services at a variety of prices. You can get investment advice from most financial institutions that sell investments, including brokerages, banks, mutual funds, and insurance companies. You can hire a broker, an investment advisor, an accountant, a financial planner, fund distributor, or other professionals to help you make investment decisions. There are financial planners and investment advisors who offer a complete financial plan. Assess every aspect of your financial life and develop a detailed strategy for meeting your financial goals. Professionals either charge a fee for the plan, receive a fee based on percentage of your assets that they manage for you, or receive commissions from the companies whose products you buy, or a combination of these. You should be clear about what services you are getting and how much they will cost. But this is a quick way to get started without having to learn everything on your own just yet. You at least get started and can learn along the journey with their professional help. Now it's time for a short quiz. And the first question is, before I start investing, I should know and understand, and the options are A, asset allocation, B, myself, C, diversification, D, all of the above, and E, none of the above. Let's now move on to the second question, which is a true or false. The only way to invest in stocks is through a robo-advisor. And your options are A, true, B, false. Question 3. Again, the true or false? Capital gains and interest are the only taxes I need to be concerned about when investing. Your options are A, true, B, false.